Have you been asked to calculate the net present value, otherwise known as the NPV, of a particular project or investment using the tables and you're not quite sure how to do it? Well, you've come to the right place because I'm Professor Capko and I'm going to show you in this video just how easy it is to do. But first, I want to say something wonderful is about to happen for you, so be on the lookout for it. And now, back to the video. I've got a problem here that's based on a problem that some students have struggled with, and we're going to go over how to do this calculation using the tables, the present value tables. So this is showing you that a company is considered investing $4,000 in a project that is expected to generate net annual cash flows of $2,000 over the next 3 years. The company requires a 10% annual return. The present value of the annuity factor for 10% in 3 periods is 2.4869. Now, if you don't know what that means, I'm going to show you what that means in a moment. The question says, what is the net present value, otherwise known as the NPV? So let's talk about what this is considering and what we're figuring here. The investment cost $4,000. So the company has to put $4,000 into this, whether it might be a piece of equipment that's expected to generate a cash flow. Maybe it's some other project, something like that. And it doesn't have to be a company, it could be a personal item, but whatever, the company in this case is investing $4,000 into this project. And they expect, now no one can predict the future, we understand that, but in finance, we have to at least kind of figure out what we expect. And in this case, for the next 3 years, it's going to generate income of $2,000. So $2,000 the first year, $2,000 the second year, and $2,000 the third year. But for NPV, we want to know what the present value is of this investment. So in other words, what is the present value of that cash flow today? And then because we want the net present value, not just the present value, we need the net present value, that means we need to subtract out from our cash flow the cost. The cost in this case is $4,000. That way we will know whether it's a good investment or not. And the truth is, if it is a positive net present value, if it's a positive number, then that's something the company should invest in, or at least it's a good investment if everything works out as expected, because you're generating a positive cash flow even with the money that was put out on the front end. If it is a negative number for the NPV, then that is not something that the company should consider investing in, because it looks like the investment will be better served in a different way. So the cash flow will not be enough to generate the 10% that the company is looking for. And that's what the company's looking for. And this is a number that the company comes up with on their own. How much do they want to generate? It may be based upon a different investment. Maybe they can just put it into some account that they know they're going to generate 10%. So that's the bottom line, or that's the base investment return that they're looking for. So do they invest in that sure 10%? And of course, nothing's sure, but do they invest in the sure 10%, or do they invest it in this other project that will generate this cash flow? And will it generate enough to outdo the 10% investment that they want to make? So let's take a look in detail how to do this. All right, so we need to figure out what is the present value of this $2,000. If you think about it, it's $2,000 over 3 years. So it's 2,000. The next year you add another 2,000, so we've got 4,000. And then the third year there's another 2,000 brought in. So there's $6,000 that's expected to come back. So in other words, the company is putting out 4,000 and they expect 6,000 to come back. And just with those figures, it looks like a good investment. We put in 4,000 and we get back 6,000. But remember, the company wants to earn at least 10% on its money, right? The company requires a 10% annual return. So it's not enough to just get to the 6,000 because remember, we'd have to subtract out the 4,000 that we invested because that 6,000 is including the 4,000. So that means we've only got a net $2,000. That 2,000 is that earning 10% interest, essentially, is what we're saying, of the $4,000 investment. So let's look at how that would work with the tables. So in this case, the problem gives you the present value annuity factor. This is a factor of 2.4869. How did that factor, where did that come from? Well, that comes from the tables, and I've done some other problems with this. In fact, if you want to see how to calculate this using a financial calculator, I've linked a video up here. So if you have a financial calculator, you can just calculate NPV using that. But in this case, you're asked to use tables, and you may or may not have seen tables like this. This is the table that we're going to use for this, and this is the present value. So we're not looking at future value, we're looking at present value because NPV is the net present value. So we need the net present value of an ordinary annuity of one, or sometimes it'll say of $1. What does that mean? Well, what is an annuity? An annuity is a type of cash flow or investment where there's a series of regular payments made at equal intervals. So if the payments are regular and they're at equal intervals, then we consider that to be an annuity. And in this case, we have $2,000 each year over the next 3 years. So we have a time period of 3 years, and the amount of cash flow does not change. It's $2,000 each year. So this appears to be an annuity. So we know this is the proper table to use. We know we're looking for present value, and this is of $1. So we know that we've got more than $1 invested. That is the $4,000, and we know the cash flows are going to be $2,000. So we're going to be doing some multiplication here, but at least we know the amount of $1. The way you use this table is you would look at the interest rate, and we look across the top till we find our interest rate. In this case, we're looking for 10%. So that's that column we're going to use. This is the column that we're going to use. And then we look for the number of periods. And in our case, it's 3 periods, right? 3 years is what we're looking at. So our problem calls for 3 years. So we go down this column until we get to 3, because this is the number of periods, 3. And that tells us which row we're going to use. So we're going to go across this row, and we're going to come down this column. It's like playing Battleship. We come down this column and across this row, and what number do we have here? 2.4869. Does that sound familiar? Yes, that's the number we're given. So in this problem, they did this work for you by providing this number. But if you are not provided that number and you have the present value table, and these are available, they may be in your back of your textbook, or you can get them off the internet. They're going to be the same no matter what reputable site you go to. Just put in present value table for an annuity, and something like this will come up, and you can get that number. Now, don't make the mistake in saying, well, that's the value. No, that's our factor. So I'm going to write down this factor, and that factor is 2.4869. And we're going to multiply that by what? Well, we need to multiply that by the $2,000 because that's how much is coming in each year. Caution, we're multiplying it by the annual amount that we're receiving in our annuity. Do not multiply it by the amount invested, and do not multiply it by the total amount received back. So we don't multiply it by the 4,000 and we don't multiply it by the 6,000. Multiply it by the cash flow per period. So in our case, it's per year. So we're going to use this number 2,000. We're going to multiply it by the 2.4869 and see what that comes up. So I'm going to use my BA2 Plus calculator here, which I really like. And the irony, of course, is that this is a financial calculator and it has an NPV button right here. So I could cheat and just use that button to calculate this. And in fact, I've got that other video that I pointed out where I calculated one for you. But in this case, I'm going to do it longhand using the tables, and it's pretty simple. And if you want a calculator like this, I've got one linked below, and it should be on your screen. You can pick one up for yourself, and they're excellent. So I'm going to put in the $2,000. That's this figure, and I'm going to multiply it by the 2.4869. And what does that give us? 4,973.80. $4,973.80. Are we done? No, because we don't want to just know the present value. This is the present value of the annuity. We've got that. That's the present value of that stream of income today. So $2,000 a year for 3 years. If we looked at the present value of that at 10%, that's the value of it. We, remember, are figuring out the net present value. So what does that mean we need to do? Put it in the comments if you know. Yes, that's exactly right. That's right. We need to subtract out the initial investment. And the initial investment is $4,000. So we need to subtract out the $4,000 from this cash flow. So I'm going to take and you can already see the answer. It's pretty simple, but we're going to go ahead and subtract out the 4,000, and that gives us a final answer of $973.80. So that is our net present value. So I'm going to write it in here as the answer to this. The net present value is $973.80. So I ask you, should the company invest in this project if they're expecting or demand a 10% annual return? The answer is a resounding yes. It looks like a good investment to me. After the investment of $4,000, their net value of this investment, net present value, is $973.80. It is a positive number and it's a decent positive number. So this looks like a good investment for this company. That's all I have for you in this video. If you have any other questions that you want me to calculate or solve, go and put them in the comments below. And I give priority to members of our channel. So if you look next to the subscribe button, there's a join button. If you click on that, you can see there's various levels of membership. And if you join and become a member, you'll have access to all kinds of things like I said, priority responses and priority videos prepared for you. There's some chats with me, some live videos we do together. So it's a great thing to do, and you don't want to miss out on that. And I look forward to you joining. And if you haven't already, I'm trying to get to 20,000 subscribers before my birthday. My birthday is quickly approaching, so help me out. You will be the difference. Click that subscribe button below and hit the notification bell so you never miss a video. Now make it an awesome day. Thank you.